afternoon and welcome to BizTech's Asian Midday Market Watch. It's the 9th of November and we have our regular Thursday guest, David Kuo, founder of the Smart Investor, coming to us out of Singapore. David, as always, lovely to have you on the show.
Selamat tinggal hari, Brian. Regular except for the last 2 weeks. Yeah, so you had a break.
Yes, regular except for the last 2 weeks. Now, David, before we get your insights, we're going to take a look and see how markets across the region have performed. But first, let's take a look at how crypto markets look like. Bitcoin is at 36,771. It's up 4.02%. Ether is at 1,926. It's up 2.15%. Now, looking across the regional stock markets, we start first where you're at. The Straits Times Index is up 0.05%. We've got the KLCI, which is down 0.39%. Shanghai is up 0.1%. The ASX All Ordinaries is up 0.2%. The Nikkei is up 1.51%. The Hang Seng is down 0.34%. Rounding up the numbers, we've got the Kospi, which is up 0.3%. Now, David, your view on market performance in the first half of the day, it looks like the Nikkei had quite a good day so far.
Nikkei had a pretty good day, but I think as far as the rest of the markets are concerned, a bit of a mixed bag. People have to turn to America just to have a look at what went on there last night. It looks as though the S&P 500 and the Nasdaq are still on a winning streak at the moment, but the Dow gave up some of its gains to close down for the day. So people are hoping that the American market will continue to rise, which therefore means that it will have some spillover effect over here in Asia. Specifically here in Singapore, Brian, we had some results from Singtel, which were pretty good. And as far as Hong Kong is concerned, there's some problems there with regards to the property sector, which I hope we will be talking about a bit later on.
Okay, let's zoom in on that. For the first thing, however, is deflation has come back to China again. Consumer prices fell 0.2% in October. That story is repeating itself quite a bit. David, what does that mean for investors?
I think that is also one of the reasons why the Hang Seng Index is down today. We had some consumer prices numbers come out from China today. We also had some producer prices index numbers out today, and they were both in the negative, which means that prices are falling in China, despite all the efforts that the Chinese government is putting into driving up prices. And it seems as though consumer demand just isn't there at the moment, Brian. And because of a lack of demand, it means that prices are being cut. I don't know what China's going to have to do because, I mean, it's already cut interest rates, short of actually looking at some kind of fiscal or tax measures in order to drive up demand. If that doesn't happen, then I think, that dreaded two words, the lost decade, which applied to Japan many, many years ago, could be repeating itself in China. And I think some people have also alluded to the fact that it's a demographic problem, that they have an aging population and the older people are probably reluctant to go out and spend money at the moment, simply because of the confusion that is being created by the Chinese government. They don't really understand what exactly is going on. It looked, to all intents and purposes, a few years back, that China was on the crest of a wave. It was riding high. And then suddenly everything started to fall apart. First of all, the tech industry, and then followed by the property sector. And now maybe it's running out of ideas, or maybe it's even running out of money. I mean, that's an even worse worry, I think. Has China actually sort of run out of money at the moment to try and drive some kind of economic growth through government spending?
Okay, something curious was on the cards in the media. Speaking of property, there was a Reuters story that suggested that Ping An Insurance was asked to buy Country Garden, the property developer. That sounds kind of bizarre to me, but perhaps you know a little bit, David, that you could enlighten the viewers on.
Well, I was very interested in this story simply because I am a shareholder in Ping An Insurance. And when I saw this story, I thought, oh my goodness, what exactly is going on here? Now, Ping An Insurance is a very profitable insurance company. Country Garden, on the other hand, is a very unprofitable, loss-making property developer. And the story that Reuters broke was that Ping An Insurance was asked to take a majority stake or literally buy over the whole of Country Garden. Ping An has since come out and denied the story. They said they have not received any request by relevant people or relevant authorities to take over Country Garden. What does relevant actually mean? If somebody actually sort of phoned up Ping An and said, okay, somebody up above would like you to take over Country Garden. I mean, is that person a relevant person or a relevant authority? And I think, that is the crucial word. What exactly does relevant actually mean in the China context? But anyway, the bigger story is that Country Garden is in trouble. Ping An has a lot of money, and maybe somebody did ask them whether or not they would consider buying over Country Garden to try and save it. As a shareholder of Ping An, I would be aghast at the thought of Ping An Insurance spending my money to go and buy a loss-making.
Do you think that will be, and David, then will there be a sell-off, or because Ping An Insurance has a fairly diversified ownership base,
Yes.
institutional money as well?
Yes.
So do you think that that's going to be a sell-off then, if perhaps there's a little bit of truth in this, where there's smoke, there's fire?
Well, there already has been a sell-off. I mean, the company has lost a couple of $1 billion in its market capitalization already. But hopefully, it will draw a line under this and say that it has no intentions whatsoever of buying a loss-making property developer. I can understand insurance companies buying real estate assets for the purpose of generating the income. So if Ping An said I was going to buy an office building, fine. I would be quite happy with that because it's putting its money into a business or a asset that generates recurring revenue. But if you're going to say it's going to use the money to go and buy a loss-making property developer just to try and sort of save not only the developer but also the economy, then I would say not really, no. So if it was put to the vote to shareholders, I think the majority of shareholders would say no, we don't really sort of want to get involved in this.
Now, on a final note, David, I want to talk about a stock that you've liked in the past that's perhaps making a comeback. Disney. So Disney, has it turned a corner because it's come up with better than expected fourth quarter results?
Okay, so we're going from one Mickey Mouse business, namely Country Garden, to a proper Mickey Mouse business, right? The House of Mouse, Disney. I mean, it came out with full year results, fourth quarter results last night. They were pretty good. Revenues were up, they beat expectations. Profits were up, they beat expectations. But I think there is this ongoing battle at the moment between an activist shareholder, Peltz, and also Disney. And Peltz would like the company to be even more aggressive in terms of cost cutting. And I think this is something that Disney will be embracing. It's already said that it will be trying to sort of cut $7.5 billion worth of costs from the business. But the danger is this, Brian. If you start cutting costs, and let's not forget, the main part of Disney's business is generating content. If they do start cutting costs, is that going to impact the content side? Are they going to be able to produce the kind of movies that people want to subscribe to? At the moment, Disney Plus is, ESPN is doing okay. The subscriber numbers are increasing. The theme parks are doing fine. But I think if they do too much cost cutting, which will appeal to certain investors. If they do too much cost cutting, I fear that is going to sort of damage their content. And if their content isn't good, it's a chicken and egg thing, like most businesses.
And that's a long-term impact. Maybe perhaps a short-term gain for long-term loss.
And I think that is the problem. So it has to be a very fine balance. And who better than Iger to actually sort of balance the cost cutting and at the same time generating the compelling content that people want to watch, Brian? Just like our show, the compelling content that people want to watch.
On that note, David, thank you very much for your insights. Thanks for coming on the show.
You're welcome.
Now, we've been speaking to David Kuo, founder of The Smart Investor, coming to us out of Singapore. And this has been BizTech's Asian Midday Market Watch. I'm Brian Fernandez. This show will be on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.